Hey everyone, welcome back to the channel and thanks so much for joining me today. If you've been following my content for a while, you already know that I'm constantly digging through different corners of the market looking for overlooked and undervalued opportunities that most investors simply aren't paying attention to. And recently, there's been one area that has been catching my eye in a major way. I've been studying the financial and fintech sector closely. I've identified several compelling penny stock opportunities that are all trading under $2 per share right now. Now I know what you might be thinking. Financial penny stocks sound risky. They sound unstable. But here's what many investors fail to realize. Within this beaten-down corner of the market, there are real companies with real assets, real customer bases, and real revenue models. These aren't dead-end tickers. These are legitimate businesses that have been pushed to extremely low valuations because of market sentiment, macro pressures, and short-term volatility, not because their core operations are broken today. I'm going to walk you through 3 financial penny stock opportunities trading under $1 to that stand out in 2025, explain what makes the broader financial sector interesting right now. Most importantly, break down why patient, disciplined investors may find real upside in these setups. So stick with me as we look at 3 different under $2 financial companies that could offer meaningful long-term potential if market sentiment shifts. But before diving into the individual names, let us take a moment to understand why financial penny stocks, even when they seem risky, can sometimes become incredible value plays. Over the past year and a half, the financial sector has been under pressure from rising funding costs, shifting regulations, credit uncertainty, and widespread market fear surrounding smaller institutions. Many investors have avoided financial stocks entirely, forcing valuations to plunge well below intrinsic value. However, that same pessimism has created mispricing, especially among companies with strong customer bases, real assets, and operating history. Financial institutions often benefit when interest rate environments stabilize or begin trending downward, since lower funding costs and more predictable yield curves help restore their margins. In addition, many smaller banks and fintech lenders hold variable rate loan portfolios, allowing them to improve income streams when market conditions normalize. Most importantly, many of the financial penny stocks we are discussing today are trading at deep discounts to book value or revenue potential, meaning the market is assuming a worst-case scenario that does not necessarily reflect the underlying business strength. The 3 companies I'm about to break down vary widely in their business models, but they all have one thing in common. The current market price does not reflect the true operational value of the company. Our first company operates as a regional financial institution, serving a mix of individuals, small business clients, and commercial borrowers across multiple states. Trading under $2, the stock has seen a significant pullback from previous highs, creating what many value-focused investors would consider an attractive entry point. Despite the decline, the company maintains a stable deposit base, traditional lending operations, and a diversified borrower mix. What makes this situation compelling is the series of recent steps the company has taken to strengthen its financial footing. Capital ratios have improved meaningfully following strategic recapitalization efforts, and management has focused heavily on improving liquidity and rebuilding confidence. The market's harsh reaction has more to do with sector-wide concerns than with any collapse in the bank's core operations. The franchise remains intact, and deposit flows continue to stabilize. The bank still provides a full suite of financial services: consumer lending, business lending, fee-based services, and long-standing community banking relationships. For investors who understand the cyclical nature of financial stocks and the history of deep value opportunities in this sector, this type of setup often represents a chance to acquire equity in a functioning financial institution at a steep discount. Our second company focuses on community-driven financial services and operates under a federally regulated framework designed to support economic development. This name has drawn increased attention due to unusual trading volatility and significant institutional activity. Its stock price movement has triggered interest among traders watching for strategic catalysts, insider activity, shareholder pressure, and ongoing discussions about restructuring or acquisition possibilities have also contributed to the renewed spotlight. In situations like this, strategic interest can lead to revaluation, especially when management is openly pursuing initiatives aimed at enhancing shareholder value. Our third opportunity steps outside traditional banking and into the fintech space, focusing specifically on financial services for highly regulated industries. Trading near the $1 range, this company offers banking, lending, payment processing, and regulatory compliance solutions for businesses that often cannot access traditional banking partnerships. What sets this company apart is the progress it has made in the last year regaining exchange compliance, structuring debt, raising capital, and positioning itself as a comprehensive financial solutions platform for an underserved market. In an industry where many businesses struggle to access secure financial infrastructure, a company with specialized banking technology can stand out dramatically. The company's ability to secure new equity arrangements and eliminate most of its debt has strengthened its balance sheet considerably. Profitability on an adjusted basis over multiple years suggests the underlying operation is far more stable than typical penny stock fintech names. As regulatory clarity improves in this sector, demand for secure financial platforms will only increase, placing this company in a favorable position to capture market share. What ties all three financial companies together is a clear disconnect between current market sentiment and long-term operational potential. Whether it's undervaluation after recapitalization, strategic interest among institutional investors, or a fintech platform positioned for sector expansion, each opportunity showcases a unique setup that could lead to strong upside. If the companies execute effectively, market visibility, capital improvements, sector recovery, or regulatory developments could all serve as catalysts moving forward. However, as always, financial penny stocks require caution, due diligence, and proper portfolio sizing. These are high volatility positions where patience and risk management matter just as much as timing. Regional financial stocks come with significant risks that every investor must understand before taking any position. These companies operate in an environment where competition from large national banks, digital-first platforms, and rapidly advancing fintech players is stronger than ever. Economic slowdowns constrain credit quality, pressure loan performance, and reduce deposit stability. Regulatory shifts often appear with little warning, potentially reshaping entire business models overnight. Interest rate fluctuations can swing profitability sharply in either direction. The first company we discussed is still working toward consistent profitability and remains in the early stages of stabilizing its operations. The second financial institution has struggled at times to produce steady earnings and one continues to navigate strategic changes. The fintech company serving the cannabis industry is operating in a regulatory landscape that is still evolving, filled with uncertainty and subject to major policy shifts at both state and federal levels. Any one of these stocks could continue moving lower. It is absolutely possible to lose your entire investment. These are not safe bets. These are higher risk, high volatility opportunities intended only for investors who fully understand the environments these companies operate in and who are comfortable managing elevated levels of uncertainty. Position sizing is crucial. Never allocate more money to a single speculative financial stock than you can afford to walk away from. These kinds of investments should remain a small portion of a well-structured, diversified portfolio, and above all, do your own research. Review company filings. Study their revenue models and customer bases. Understand how each business responds to regulatory developments. Don't rely solely on this video or any single analysis. Use this as a starting point to build your own thesis. Always have a clear plan. Know your exit strategy, and decide in advance where you will take profits, and set firm boundaries for when you will cut a loss. The investors who succeed are the ones who stay disciplined, not the ones who react emotionally to daily market noise. If this breakdown helped you and you want to go deeper, I encourage you to explore these companies further and form your own independent view. Drop your thoughts in the comments. Are you bullish on these financial penny stocks? Or are you staying on the sidelines? Let's talk about it. If you found value here, make sure to hit the like button and subscribe. It truly helps me continue bringing you detailed, research-driven investment content. Thanks so much for watching, and remember, the best investment is the one you fully understand. Stay disciplined, stay informed, and never risk more than you can afford to lose. I'll see you in the next video.